It can take a little while to understand how investing works. To help with this, in this video, we will review some of the ideas from the Investing 101 video as we go through some of the common myths on this topic. Myth number 1. You shouldn't invest unless you know a lot about finance. We tend to look at investing as something that should only be done by people with high-powered jobs wearing suits. Actually, thanks to a variety of apps and investing platforms, investing is now more accessible than it ever has been. It's something you can take advantage of, even if you're not on the Forbes billionaires list. There's no doubt about it. Investing is risky because of the potential to lose all the money you invest. One key way around this is to avoid investing more than you can afford to lose, especially when you're starting out. This is really important. Myth number 2. You must be rich in order to invest. You can invest very small amounts, even as little as £1 on some investing platforms. In fact, you can even buy a fraction of a share. For example, a single share in Amazon is currently worth around $3,000 US. If you have only £50 and want to invest it in Amazon, you could buy a fraction of a share. You don't need to wait until you're rich to start investing. In fact, the earlier you start, the better your returns can be in the long run, thanks to the magic of something called compounding, which means that the money you earn from investing can go on to earn you more money. If you invest, for example, £200 a month for 40 years in investments that generate a generous 10% return each year, you would have over £1 million at the end of the 40-year period. The amount of time you invest for is very important. If you invested the same £200 a month for just 10 years, at a return of 10% annually, you'd have only around £40,000 at the end of the 10-year period. Much less impressive. Myth number 3. In order to be a successful investor, you have to actively monitor your stocks every single day. Yes and no. This depends on whether you are making short-term investments or long-term ones. In the case of a short-term investment, you buy a share and sell it soon to make a profit fairly quickly. This could mean a few days or a few months, but it's typically less than a year. In the case of a long-term investment, you might buy shares of funds and hold on to them without selling them for a longer period of time, say several years. You could have a mix of short-term and long-term investments, or opt for one over the other. You'll also hear a lot about active and passive investing, so it's worth clarifying the difference between these two. In order to do this, let's first talk about what an index or benchmark is. For example, the S&P 500 is a list of the largest 500 companies in the United States. This list is commonly referred to as an index or benchmark. There are many other indices aside from the S&P 500. The performance of an index increases or decreases based on the value of the companies within it. Investment management companies like Vanguard allow you to invest in a passive fund that tries to match the performance of indices such as the S&P 500. They do this by buying and selling shares of the companies within the index. Passive investing involves you buying one or more of these passive funds and holding it for a long period of time. Because of this, as a passive investor, you spend much less time on day-to-day buying and selling of shares or funds than an active investor would. More on active investing later. When you invest in a passive fund, you are betting on the fact that over the long term, the overall value of companies in the stock market, and therefore the average value of funds, generally increases. This means that over a long period of time, which could be several years, you expect the overall value of your funds to increase, so that when you finally sell them, you can make a profit. The fees and risks associated with passive investing tend to be lower than with active investing. Also, if you are investing passively over a long-term period, you do not need to monitor your investments every day. Active investing, on the other hand, involves choosing specific company shares that you believe will increase in value more than others will. You can actively invest by choosing shares yourself, or another option is buying an actively managed fund where a fund manager chooses the shares for you. They will try to make you a higher profit than you would get from buying one of the indices or benchmarks mentioned earlier. They will normally choose a particular benchmark and try to outperform it. As an active investor, you do need to carefully study the companies you are investing in. Ideally, you look into company reports and factors such as their revenue, which is the amount of money they make over a certain period of time. you examine anything that gives them an edge over other companies. You stay up to date with global news about them and trends in the industry that could put them at risk. For example, if you're looking to buy shares in Oatly, which makes oat milk, you need to stay in the loop about developments such as new rules about whether oat milk can be classified as a milk product, because these could affect the company's performance and share prices. In other words, as an active investor, you need to do a lot of research so that you have clear and convincing reasons to buy shares in one company over another. Even then, active investing is more risky than passive investing. Unexpected things like global events or new laws can occur all the time that can affect the value of a particular company's share. Also, depending on how you do it, because of the amount of research involved, active investing has higher associated fees than passive investing. Myth number 4. You can only invest in shares in a company. You can invest in shares and funds. See the Investing 101 video for more on this. There are many other things you can invest in as well. For instance, commodities, real estate, and bonds. Commodities include things like raw materials and products, such as gold, oil, and coffee. Real estate includes land and property. Bonds are a way in which companies and governments raise money. When you buy, say, a government bond, the government is borrowing money from you and promising to pay it back over a specific period of time, with interest. The interest is your reward. Although there are a lot of options, it's best to start out simple. Always stick to what you understand. Myth number 5. You need a stockbroker or someone to handle your investing for you. Actually, there are a lot of apps and platforms you can use to invest directly in stocks without needing a middleman. And these can be really helpful to reduce the cost of your investing, especially when you start out. When you choose an app or a platform, though, be wary of costs. Most apps will charge you a certain fee to invest, and even if they seem small, these can actually be quite significant in the long run. You may want to share the options you're considering with someone who has more experience with investing to get their advice on the most cost-effective one. For example, Trading 212 is a trading app that allows you to invest £2,000 without paying them fees, except for a 0.15% fee if your investment requires a currency conversion, from say pounds to dollars if you're investing in an American company. If you invest over £2,000, you pay them an additional 0.7% commission on amounts above that limit. If you found this video useful, please like it, share it with others, and subscribe to the channel for more money videos.